Hey traders, this is Blake Morrow with Traders Summit, and with me today I have the one and only Eric Basmajian from EPB Macro Research. It's good to see you again.
Good to see you also. A lot has changed over the last couple of weeks. A lot of volatility.
A lot of volatility, and just before we hit record, and we were talking just a little bit about, it's amazing stocks are where they're at in the face of the Fed this next week, probably going to raise. At least we think, maybe following the inflation data, we think that the Fed's going to maybe increase their taper purchases and wrap this up, maybe into the end of first quarter 2022. And yet stocks are still brushing all this off. So what do you say, Eric? What do you say to all of this madness that we're seeing in the markets?
Yeah, the headline stock index, so mostly the S&P 500 is absolutely chugging to new highs, carried mostly by, I would say, the four horsemen or the five big tech stocks that we all know of. But under the surface, there's been some interesting things that have been going on, and I'd like to share my screen just to sort of set the stage with
please do.
The charts that I like to bring. Just so that we're dealing with data here. This is, if people have seen the last couple of conversations that we've had, this is what I call the four corners of the economy. We have our production, our employment, our consumption, and our income. And what I do at EPB Macro Research is I track these cyclical trends. So is the growth rate broadly increasing, or is the growth rate broadly decreasing? Not really looking at the actual growth rate itself, but more the rate of change or the direction. And we can see that, relative to this March-April peak, we have a pretty persistent decline in production growth. Employment growth on the top right is declining. It's hovering. It's probably the strongest of the four. Consumption growth is declining from that really artificially boosted stimulus level. And then the one that's taking the biggest hit because of the inflation trends that we're seeing is real income. And we can combine these four together to sort of get a really real-time gauge of the direction and growth. And we can see that over the last 8 months, growth has absolutely been coming down. So what does that mean? Growth was coming down the last couple of times we talked, and I said that generally when growth is declining, and specifically when the Fed is tightening, that creates a volatility pocket for risk assets. And while the S&P 500 has moved to new highs, we have definitely seen an elevation of that baseline volatility under the surface. So the NASDAQ is doing really well, but if you look at the Russell 2000, a more cyclical index, it's at the same level that it was in February of 2021. So going on 8-9 months here with no gains. And we talked in the earlier part before we hit record that there was a pretty wicked head fake in the Russell that I think if you weren't aware of some of these cyclical trends, you may have been more inclined to chase that breakout. But when you have the grounding of these cyclical trends, we were able to sit there and say, hey, look, growth is declining. And then we look at our leading indicators and we say, there's really no indication that growth is going to continue accelerating. The Russell 2000 should not be breaking out here. And sure enough, we got a pretty hard reversal. So I like to kind of parse out what parts of the market are making new highs. We see utilities have started to gain some strength. That's a defensive sector. Yeah. And the yield curve continues this flattening. And it's sort of one of those things that you can ignore long enough. And then one day risk happens slowly and then all at once. So I still see some pretty consistent signs of this growth slowing going on.
Okay. And I was going to say it, and it is interesting how the market, the market and market participants in general, and especially when you're listening to, talking heads and, people, whether, it's, macro guys like yourself or gals or economists or different economists or even traders or portfolio managers. It's like they cling onto a theme soon as it appears, but being able to see it ahead of time is a whole different ballgame. And so what you're showing us here is, we don't have really the support that the market would really need to take off to new highs. But let me ask you this, Eric, as we are sitting here at the end of the year, and seasonally it's not a bad time to be in markets. A lot of people, quote unquote, they see the Santa Claus rally in stocks, and you get fund managers and portfolio managers that just are chasing yield higher. I don't know if it makes sense to to necessarily stand in front of the market right now, even based on the data that you're seeing. But at what point, in going into 2022, maybe the beginning of the year, do we start to see an inflection point in the markets where it starts to take a look at some of this hard data that you're showing us right now?
Yeah, that's a really great point. So from where I sit, whenever I see a growth slowdown, like we've had, I do tend to shift my exposure. I think I mentioned last time, into some of those more safe, defensive type sectors, which even though it sounds a little counterintuitive, the technology sector does trade defensively because the big five companies have these long duration cash flows that are perceived to be immune to the economic cycle. So whenever growth in the economy starts to decline, everyone crowds into the five stocks that seemingly have at least a little bit of growth.
Yeah.
But to your point, in my view, the market's getting, or at least the broad market and some of the cyclical currencies, is getting a little bit of a relief rally, because a lot of people are looking to this GDP nowcast for Q4, and we're seeing this big pop in Q4. Growth is, at least based on the Atlanta Fed, looking like 8% in Q4 after basically a stagnation in Q3. So a lot of people are looking at that, and like you said, just sort of looking at the narrative and then painting a picture around it, saying growth in Q3 was slow because of the Delta variant, and now we're getting this pop in Q4 and we're off to the races. But at EPB Macro Research, what I do is I look at these coincident indicators, but that just tells us where the economy is trending now. It doesn't tell us where we're headed. For that, we have to look at the leading indicators, and none of the leading indicators that I look at suggest that this pop is going to be sustained. It's going to be a head fake based on where I sit. Now, growth can oscillate every single month. That's not cyclical. Those are just month-to-month oscillations. And with these shortages, we have the starts and stops of the auto sector, which is really swinging growth around. But when you look at cyclical trends, which are a couple of quarters, there's nothing that's going to stop that deceleration. And like you said, the Federal Reserve is gearing up to be more aggressive. So I believe that the market is wrongly anticipating that the growth slowdown was sort of a temporary blip and not something larger of a more organic underlying cyclical slowdown. And I think that as we move into Q1 and the growth and this pop that we're seeing in Q4 doesn't sustain itself, the market will have a realization that, oh, wait, that was just a head fake. We do have this slowdown. Oh, and by the way, the Fed is tightening policy on the other hand.
Right.
And if we look at one market that's a little bit less sensitive to the headline news and what vaccine came out today and whatnot, we look at the Treasury bond market. That flattening that we've been talking about is relentless. There's been almost no letting up of that flattening based on any of the more traditional spreads that you like to look at, like 10s, 2s, or 5s, 30s, things like that. So that's where I think that the rubber is going to meet the road, is as we move into Q1, the market's going to have this realization that this growth pop is just a head fake, at least from where I sit.
So let's turn your attention, and thank you very much. Let's turn your attention to inflation. And by the time that everybody's watching this video, it's probably going to be the inflation data has already been out. But President Biden came out today and he warned basically Joe and Sally Public, look, don't fear the data that's coming out tomorrow. Because
right.
I try to explain to the traders in our community, it's like, okay, Joe and Sally Public, they see, whether it's 6.2 annualized or it's 7% annualized, it's just high. Doesn't really matter.
It's a big number.
It's a big number, but expectations are for price 6.7, 6.8% tomorrow for annualized CPI. And whether it comes in above or below expectations, we as traders will react to that. But I want to ask you this, would I should take that back. Would an inflation print that comes in below expectations, or maybe even above expectations, is that going to shift the Fed's policy decisions that are going to happen next week? Is the Fed going to go, well, we don't have to increase our taper purchases because the inflation data is weaker. So what do you think? I mean, do you think the Fed's going to be influenced at all by the data tomorrow?
I don't think so. I think that the Fed has at least mostly made up their mind, and at least as far as the next month. And I'm hoping I could pull up a chart here of some inflation trends that I see. Let me see if I could grab this chart really quick. Okay,
Yeah, sure thing.
Here we go. So you can see this consumer price index chart.
Yeah.
So I think I mentioned in the last couple of calls, I stay away from the traditional year over year. I do look at year over year, but I think that we can do a little bit better by looking at some more timely measures. So this is a smooth 6-month annualized growth rate. So it moves a little bit faster than a year over year, and it's less influenced by the base effects, which we know have been a little bit problematic with COVID. And based on this, inflation's already running at 7.1% based on the last report. And I modeled out the estimates, the consensus estimates for the next report. And if we come in anywhere within the consensus range, this is going to be somewhere between 7.9 and 7.2 on the next reading. So we're seeing another increase in the rate of inflation. The problem is that we're seeing wage gains, but we're not seeing wages that are rising faster than 7%. A lot of people are citing wage gains that are maybe 5 or 6%, but if inflation is going to be 7, 7.5, 8, we're seeing declining real wages.
Yeah.
So I don't think the Fed is going to be influenced by the inflation print because it's going to be high regardless of what it is. And like you said, it's really politically tough for them to sit there with a 5 handle, 6 handle, 7 handle on inflation and do nothing. But again, this is a coincident indicator. This tells us what inflation was last month or what the trend in inflation was over the last couple of months. We also have leading indicators of inflation. And what I can tell you is that I can't pick the top in inflation to the month, but most of the underlying drivers of inflation, the leading indicators of inflation, have started to move to the downside. So this isn't going to be able to pick the inflation print to the peak, and a lot of it's going to depend again on this auto sector issue. That's really the bulk of the problem. But what we're going to see here is that as we move into 2022, at least based on my data, unless we run into another unexpected supply chain issue, we're going to see this growth rate start to peak and trend lower. And one of the main indications of that is commodity price growth.
Yeah.
We've seen commodity price growth really start to at least level off, which is going to pull this number down. But as President Biden was quick to point out, most of the commodity price declines were in December, which won't come into the report until January. But aside from commodity price growth, we have some underlying cyclical drivers of inflation that have started to peak and move down. The one area of inflation that is the most problematic is this durable goods inflation. And that's mainly a function of these used cars. And we know based on this Manheim used car index that in November, there was another increase in used cars. So this durable goods inflation may accelerate again from 15% to 16, 17%. We'll have to see what the whole thing comes out to. But if we want to really focus in on what the inflation story is, it really is 100% the durables. And that's not ending next month based on the used car prices. But I would suspect that as we move into 2022, this growth slowdown that I pictured earlier is going to be met with an inflation cycle downturn as well. And the Fed is going to tighten into that. So I'm still in the camp that this elevated baseline volatility that we've seen in markets is going to carry through to the new year. But we may have these 5 stocks, which are perceived as defensive, continue to do well. But I would challenge everyone to look under the hood if you're equity centric and maybe look at the Russell, maybe look at some of the industrials, the transports, some of the financials, things like that. We have seen some turbulence build into the markets. And then I know a lot of your listeners are big with the currencies. I would still be very cautious of the cyclical currencies given these trends. So Aussie, Canadian, Brazil, Chilean peso. I'm not sure how actively those trade. I look at them more as signals, but I would be on the bearish side of the cyclical currencies from a cyclical perspective. So on a couple of quarters, I can't tell you every month or so. But
right.
that's what you guys are there for. You guys are the traders.
Yeah, well, the fact of the matter is you take the Australian dollar did, over the last several months hit a new 2021 low. Yes, we've had an aggressive bounce over the course of the last, week or two, but that doesn't mean that the trend has changed, right? So, as you point out, the cyclical factors will probably continue to weigh in on those types of commodity currencies. But, I wanted to talk just one more subject with you. You and I have had some discussions about China. China's been pretty active over the course of the last couple of weeks. What do you make of the China situation right now with what the PBOC has been doing?
Well, I'm glad you brought up China. I got one chart here that I would really love to show on China.
Am
I sharing my screen?
Yeah. Go ahead.
Can you see it, or am I not?
I cannot see it just yet.
Okay. Let me. I really would love to show this, and
please do.
I'm sorry if I ramble too much here, but
no, this is good. I mean, because China, obviously, like I said, they've been pretty active over the course of last week.
So this is I think one of the most important charts of the next couple of years. So this chart shows the growth rate of the working age population, and the working age population is the absolute most critical demographic trend, because once you're over 65, you're not buying new houses, you're not buying new cars traditionally, usually leaving the labor force. So your peak rates of consumption, your peak rates of income, your peak rates of family formation are in this 15 to 64 bucket. And what we see is that one of the best signs of asset prices, or real estate prices most specifically, hitting a peak is when the working age population is contracting, or when there's less people in the 15 to 64-year-old demographic. It makes sense, right? If you have the same number of houses or more houses and you have less people, then it's really tough for those houses to go up in value. Japan is the poster child for bad demographics, and their working age population started to decline in the early 90s, which is very timely with when their real estate bubble in the late 80s kind of burst. And since the 90s, Japan has never been able to recover. They hit 0% interest rates, negative interest rates, and they never were able to recover because their working age population, graphed in purple here, is in a persistent decline. They have less people in this bracket.
Yeah.
Europe, they never recovered after 2009. After 2009, they hit 0% interest rates. They tried negative interest rates, and they've never been able to get off negative interest rates. In the US, from 2010 to 19, we had an episode of attempting to raise interest rates and shrinking the balance sheet. Didn't work very well, but at least we tried. In Europe, they never even got off negative interest rates, right? And a lot of that has to do with the fact that they now have a contracting working age population, which is basically curtains for an economy. China did a real number on themselves with some of their demographic policies, and their working age population started to slip into contraction in 2015. And what's ironic about 2015 is that's when we saw the first major devaluation of the yuan.
Yeah.
China tried to slow their real estate investment there because there were some hiccups. But whenever they try and slow their real estate investment, because their economy is so levered to real estate investment, it tends to not go well for the global economy or for China. But China has a persistently contracting working age population. It's been contracting since 2015, and it's only going to get worse. So it's not a surprise at all that we see China running into persistent real estate problems. So now China, like you said, they're trying to ease policy. We don't know if they're going to try and hit the gas again on this real estate investment, but they're not going to be able to escape whether it's a gradual or an abrupt deleveraging of the real estate sector, because they keep putting up more and more apartments, more and more homes with less and less people. So this is a demographic force that's going to weigh on China massively. And they're really struggling to try and reorganize their economy away from real estate investment towards something else. They haven't exactly figured out how to do this. They're going to try and let the air out of this balloon slowly, but it doesn't seem to be working very well. And there's going to be basically nothing that they can do to reverse this because these demographic trends are so slow moving. So the scariest chart here is that as we move into the 2020s, Europe, China, and Japan, three of the four largest economies of the world all have shrinking working age population. It's going to be a very, very difficult for the global economy over the next 10 years as a result. So,
wow.
so to answer your question as succinctly as I can, they are going to try and ease, but it's not going to work. They're going to have to do a lot more, and there's nothing that they're going to be able to do. They're going to have to let the air out of this real estate bubble.
Well, that's a really, really eye-opening chart that you're showing us, Eric. And I think it's something. I'm not sure what the trade is here. As somebody who's
it's so slow moving. It
is very slow moving. But I guess the fact of the matter is if you're looking at a chart like this and you're like, okay, how is it, or when is it that China is going to dethrone the U.S. as it really on a global scale? Is that even possible over the next 10 years based on just this one chart that you're showing us? I know there's so many other factors that feed into this, but
exactly. We could do a whole other conversation on this. Sure.
Right. I might even second guess my Australian dollar long exposure moving forward because of this. But Eric,
as long as you don't hold it for 5 years.
Straight, right. Okay. Okay. Hey, the carry is not so bad, but maybe it might be.
Right.
But Eric, I want to say, the charts and the conversations that you open up, I love having them. I'm so glad that we have an opportunity to speak every couple of months. I do want to speak with you at the beginning of 2022, get kind of your outlook going into this next year. But if I'm at home, I'm listening to you and I'm like, man, I think Eric's a sharp guy. How do I follow your work?
Sure. So I love these conversations, and I'm always willing to come on as frequently as you'd like to have me. I'm pretty active on Twitter. You can follow me at EPB Research, but more specifically, EPBMacroResearch.com is where you can find all my work. There's a contact box. You can shoot me an email. You can follow along our email list, our blog. And I also put out a monthly report, which covers the cyclical trends that we just talked about in the earlier part of the show. And I put out a quarterly report, which goes into those secular trends like that last chart I just showed. So that's
amazing stuff.
That's where you can find me.
Awesome. Well, Eric, thank you so much. Happy holidays to you and your family. Thanks for spending your time with us today. If you guys like these videos from Eric, make sure you give him a thumbs up, subscribe to the channel so you don't miss any of our other content that we have. Eric, thanks again for joining us.
Thanks so much, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.